You've been told the 2008 crisis was about bad mortgages. The historical record says something more precise. On a single weekend in September, nearly every major bank on Wall Street became insolvent at the same moment. Not sequentially. Not one falling into the next. Simultaneously. That timing is the story. The real driver isn't what most coverage focuses on. The pattern you've already noticed. You've watched financial crises get explained the same way for decades. A bank takes bad risks. The bank fails. Depositors panic. Other banks get nervous and pull back lending. The failure spreads like a contagion, bank to bank, in sequence. That story is comforting because it has a villain and a clear chain of cause and effect. It is also not what happened in 2008. Bear Stearns, Lehman Brothers, Merrill Lynch, AIG, Washington Mutual, Wachovia, these institutions did not fail one after another because they lent to each other. They failed because they were exposed to the same collateral, funded through the same overnight markets, and marked their books using the same accounting rules. When the value of that collateral moved, every balance sheet moved with it, on the same afternoon. Here is what financial historians call this: a correlated balance sheet shock. Not a chain reaction. A single mechanism, applied simultaneously across an entire system. The mechanism sits elsewhere. The official explanation describes the symptom. Home prices fell. Mortgage defaults rose. Banks that held mortgage-backed securities lost money. That is true. It is also incomplete. Beneath the headlines, a different financial logic was operating, one built decades earlier, largely invisible to depositors, and structurally different from the banking system most people picture when they hear the word bank. By 2007, the largest financial institutions in the United States were not primarily funded the way a retail bank is funded, through customer deposits. They were funded overnight, through a market called repo, short for repurchase agreement. You lend a bank cash overnight. The bank gives you a bond as collateral. In the morning, the bank buys the bond back, plus a small amount of interest. Tomorrow night, you do it again. This sounds mundane. It is not. Economist Gary Gorton, in his 2010 book Slapped by the Invisible Hand, made the case that argued this repo market functioned exactly like traditional bank deposits, except it had no deposit insurance, no lender of last resort access for non-banks, and no legal floor beneath it. Gorton's core finding, the 2008 crisis was, at its structural core, a bank run, not on retail deposits, but on this repo market, and it happened almost overnight because the entire system relied on the same collateral being trusted at the same time. You see the pattern now. This wasn't one bank's mistake compounding into another's. It was one funding structure, shared by nearly every major institution, tested by the same shock, on the same day. What collateral actually meant. You watch a trading floor in early 2007. Nothing about it looks unstable. Desks are full. Deals are closing. Bonuses are being calculated for the fiscal year. Underneath that floor, an enormous share of Wall Street's short-term funding depends on one type of collateral, mortgage-backed securities, and the more complex instruments built on top of them, particularly collateralized debt obligations backed by mortgage bonds. Every major dealer, Bear Stearns, Lehman, Merrill, Citigroup, Morgan Stanley, held large inventories of these securities. Every one of them used those same securities as collateral in the overnight repo market. Every one of them relied on the assumption that these securities carried a stable, predictable price. This is the part rarely explained clearly. The danger wasn't that mortgage-backed securities were risky in isolation. The danger was that the same asset class sat on nearly every major balance sheet at once, funding nearly every major institution's daily operations. When that asset class became suspect, it did not become suspect for one firm. It became suspect for the entire system, instantly, because the collateral was structurally identical across firms. Financial economists have a term for this kind of vulnerability: a correlated exposure. Diversification protects you when risks are independent. It offers no protection when risks are shared. The historical precedent, 1907. Financial history offers a genuine analogy, not a retrofitted one: the Panic of 1907. The event, a run on trust companies in New York City. The year, 1907. The actors, the Knickerbocker Trust Company, financier J.P. Morgan, and a network of unregulated trust companies operating alongside traditional banks. The mechanism: trust companies in that era operated with lighter reserve requirements than chartered banks, funded largely through short-term deposits that could be withdrawn on demand. When the Knickerbocker Trust speculative investments were exposed, depositors did not distinguish between one trust company's specific risk and the risk of trust companies as a category. They withdrew funds from all of them, at once. The outcome: J.P. Morgan personally organized a private bailout, assembling bank presidents in his library and pressuring them to commit capital to stop the panic, because no central bank existed yet to do it. The panic directly led to the creation of the Federal Reserve in 1913. Notice the structural echo. In 1907, the vulnerable category was trust companies. In 2008, the vulnerable category was repo-funded dealers holding mortgage collateral. In both cases, the crisis did not spread firm by firm. It moved category-wide, in days, because depositors and creditors correctly recognized that if one institution in the category was compromised, the underlying assumption behind the entire category was compromised. Charles Kindleberger, in Manias, Panics, and Crashes, 1978, described this pattern as a recurring feature of financial history, a period of credit expansion built on a shared, unexamined assumption, followed by a moment when that assumption is tested by all participants simultaneously, producing what looks like contagion but is actually synchronized recognition. The reframe: this was a Minsky moment, not a domino chain. What looked chaotic in September 2008 is actually a recognizable pattern, one with a name: a Minsky moment. Economist Hyman Minsky, in Stabilizing an Unstable Economy, 1986, argued that financial systems move through predictable phases of increasing fragility. In the early phase, borrowers can cover both principal and interest from cash flow. In the middle phase, what Minsky called speculative finance, borrowers can cover interest but must roll over debt to cover principal. In the final phase, Ponzi finance, borrowers can only service debt by borrowing more, betting that asset prices will keep rising. By 2007, large parts of the mortgage securities market, and the dealers funding themselves against the collateral, were operating in Minsky's Ponzi finance phase. Institutions were rolling over short-term repo funding daily, against collateral whose value depended on housing prices continuing to rise. A Minsky moment is the instant when that rollover assumption fails, when lenders stop assuming tomorrow will look like today, and instead ask whether the collateral is actually worth what it says on the balance sheet. That question does not get asked one bank at a time. It gets asked about the collateral itself. And because the collateral was shared, the answer arrived everywhere at once. Mark T.O. Market and the Accounting Mechanism. You watch a CFO in October 2008 look at a spreadsheet. The bonds on the balance sheet haven't defaulted. Most of the underlying mortgages are still being paid. But the accounting value of those bonds has collapsed, because the market for trading them has effectively frozen. This is the part that confuses most retrospective coverage. Banks did not become insolvent primarily because loans stopped being repaid. They became insolvent, on paper, because accounting rules required marking assets to a market price, and when no one would trade that market, the price used was a distressed, panic-driven price, sometimes far below what the underlying cash flows justified. Accounting Standard FAS 157, implemented in 2007, required financial institutions to value many assets at current market prices rather than at their own internal models of long-term value. In a functioning market, this produces more honest balance sheets. In a frozen market, it produces something else. Every institution holding the same asset class is forced to write down its value at the same time, based on the same collapsing price, regardless of whether that institution intended to sell. This is the mechanical reason insolvent at the same moment is not a rhetorical exaggeration. It is a literal description of an accounting requirement interacting with a shared, illiquid asset class. Ben Bernanke, in his research collected in Essays on the Great Depression, 2000, had already documented a related dynamic from the 1930s. He found that bank failures during the Depression were not merely a monetary phenomenon, but a credit channel phenomenon. The destruction of bank capital directly reduced the supply of credit to the real economy, deepening the downturn beyond what falling prices alone would explain. In 2008, the mark-to-market mechanism accelerated exactly this kind of capital destruction, compressing years of gradual credit channel damage into a matter of weeks. Who gained? Who absorbed the cost? Ask the question financial history keeps returning to: who benefits, and who absorbs the risk? For nearly 2 decades leading into 2008, the repo-funded model gave large dealers an enormous advantage: cheap, flexible, short-term funding that let them hold larger balance sheets with less permanent capital. That funding structure gained them leverage, and leverage gained them return on equity, and higher returns gained executives and shareholders both compensation and market share. The overnight lenders in the repo market, money market funds, corporate treasurers, other financial institutions, gained a small, steady yield in exchange for what they believed was a safe, short-duration, fully collateralized loan. When the collateral was revealed to be less liquid and less independently valued than assumed, the overnight lenders gained something else, the ability to simply stop lending, overnight, with no notice period. That optionality sat entirely with the lenders. The dealers, who had built their entire funding model on the assumption that this overnight money would always be there, had no equivalent optionality. They could not instantly replace a funding source that evaporated between one evening and the next morning. This is the incentive structure underneath the headline events. The dealers gained years of amplified returns. The overnight lenders gained a costless exit option. The mismatch between those two positions is what made the failure simultaneous rather than sequential, because when lenders exercised that exit option, they exercised it against the entire category of dealers at once, not against one firm in isolation. Taxpayers, through the Troubled Asset Relief Program authorized in October 2008, and the Federal Reserve, through emergency lending facilities, ultimately absorbed the cost of preventing that mismatch from destroying the payment system entirely. Myth-busting the standard narrative. Myth: the crisis happened because individual banks made reckless mortgage bets. Reality: reckless mortgage origination was a contributing input, but the mechanism that made the crisis systemic and simultaneous was the shared, correlated funding structure built on that collateral. Why it's false: if the story were only about individual recklessness, failures would have been staggered, reflecting each firm's specific risk appetite. Instead, firms with very different risk cultures, Bear Stearns and Merrill Lynch, were run differently, by different people, with different incentives, collapsed within months of each other, because the shared vulnerability was structural, not managerial. Myth: deposit insurance made the banking system safe by 2008, so the crisis came from shadow institutions entirely outside the regulated system. Reality: the repo market sat between regulated banks and unregulated markets, and regulated bank holding companies were themselves deeply dependent on it. Why it's false: Citigroup and Bank of America, both traditional deposit-taking institutions, required massive federal support, precisely because their holding companies and trading arms were exposed to the same repo-funded, mortgage collateral structure as the investment banks. Myth: the Federal Reserve and Treasury were slow or reluctant to respond. Reality: the response was large and fast by historical standards, but the mechanism itself, simultaneous, correlated collateral devaluation, outran even a fast policy response, because the underlying trigger was a single afternoon's repricing, not a slow-building sequence policymakers could intervene in gradually. Why it's false: Adam Tooze, in Crashed, 2018, documented that the Federal Reserve extended dollar liquidity swap lines to foreign central banks within days of Lehman's failure, a scale and speed of intervention with few precedents, yet the damage to money markets and short-term credit had already propagated globally before those interventions could fully take hold. Myth: this could not have been anticipated because no one predicts a housing collapse of that scale. Reality: several economists explicitly warned about the risks embedded in the funding structure itself, independent of housing price forecasts. Why it's false: economists including Nouriel Roubini in 2006, and researchers at the Bank for International Settlements, had flagged the growth of short-term wholesale funding and off-balance sheet leverage as a systemic vulnerability well before housing prices peaked. The warnings concerned the plumbing of the system, not merely the direction of home prices. The 1930s precedent and what repeats. Carmen Reinhart and Kenneth Rogoff, in This Time is Different, 2009, examined 8 centuries of financial crises and found a recurring feature: crises are consistently preceded by rapid credit growth and rising leverage, and participants in each new cycle consistently believe their situation is structurally different from prior crises, hence the book's title, drawn from the phrase used to justify why old warning signs no longer apply. Reinhart and Rogoff's core finding relevant here: banking crises are far more often systemic and correlated than idiosyncratic, because the credit expansion that precedes them tends to be broad-based across an entire financial system rather than confined to a single institution. John Kenneth Galbraith, in The Great Crash 1929-1955, described a related feature of the lead-up to that crash: the widespread use of leverage through margin lending, where a shared mechanism, brokers lending against the same rising stock collateral, meant that when prices fell, a very large number of accounts were forced to sell at the same time, for the same structural reason, deepening the decline in a way that looked coordinated even though no coordination occurred. This is the recurring shape. Not one actor causing a chain of individual failures, but a widely shared mechanism: margin lending in 1929, trust company deposits in 1907, repo funding against mortgage collateral in 2008, that fails all at once because it was never independent risk to begin with. It was the same risk, held by many hands. What this tells you about the present moment. You don't need to know whether the next crisis involves mortgages, or something else entirely, to use this framework. The question worth asking about any part of the current financial system is not, which specific institution looks risky. It is, which funding mechanism, or which type of collateral, is now widely shared across many institutions at once. In the years since 2008, regulators required banks to hold more capital, and pushed some of the riskiest activity outside traditional banks entirely, into money market funds, private credit funds, and non-bank lenders, some of which now perform functions similar to what repo-funded dealers performed before 2008, under different regulatory categories. Ray Dalio, in Principles for Navigating Big Debt Crises, 2018, framed this as a recurring long-term debt cycle. Developed economies periodically build leverage across the system until a deleveraging event forces a correction, and the specific instrument carrying that leverage changes from cycle to cycle even though the underlying mechanism, correlated exposure funded by short-term, confidence-dependent liabilities, repeats. You watch new categories emerge: private credit, leveraged loan funds, certain forms of stablecoin reserves, and the relevant question is not whether any single fund looks fragile. It is whether many funds are relying on the same underlying collateral, valued the same way, funded on the same short-time horizon. The structural logic, stated plainly. You watch financial coverage describe crises as stories about specific villains, reckless traders, greedy executives, careless regulators. Those actors exist. They are not irrelevant. But the deeper question is not what happened. The deeper question is why it keeps happening, in different assets, across different decades, with different names attached each time. The answer financial history keeps returning to: modern financial systems repeatedly build large, shared exposures funded by short-term, confidence-dependent liabilities, and when confidence in the shared collateral breaks, it breaks for everyone holding it at once, not one institution at a time. That is what actually happened across that September weekend in 2008. Not a sequence of individual bank failures. A single, shared assumption about mortgage-backed collateral, tested at the same moment, by lenders who had no obligation to wait and see. The next time you hear a discussion about a bank failure, a fund closure, or a sudden market freeze, you won't just be watching which institution is named in the headline. You'll be asking what collateral, or what funding structure, that institution shares with everyone else. You'll be asking who holds the option to walk away overnight, and who does not. You'll be asking whether what looks like one failure is actually many balance sheets, quietly built on the same foundation, waiting for the same afternoon. If you want more videos like this, subscribe.